again, everyone, and welcome to another special sponsored episode of the Auto Remarketing Podcast. I'm your host, Nick Zulovich, part of the team at Cherokee Media Group and senior editor of AutoFin Journal and Subprime Auto Finance News. For this episode of the podcast, pleased to welcome back a familiar and expert voice, John Elias with Allied Solutions. John, it's great to have you back on the program. How are you, sir?
I'm doing well, Nick. How are you?
Doing well, and kind of the theme and focus of our conversation this time around is kind of a pulse check on auto finance and whether there are blind spots and borrower risk. So just to get us started, John, we're about halfway through the year already. That's
Mhm.
amazing to say. Just what would you say is the pulse of auto financing? How would you describe the current lending environment that we have here in 2025?
Boy, I tell you, Nick, I love sharing information on this topic just from observations that we've seen here at Allied. More importantly, our interactions with our clients. I mean, I think that it was in 1993, I started at a dealership picking up phones. You'd call that a BDC these days. Moved to the sales floor, and then I moved into the F&I office a year later. And as part of that, I was taught the three C's in lending, right? Where they were credit, capacity, and collateral. And I think that as I go through some of the things that we're seeing to answer your question, I think that's going to be the tone, right? Those are kind of what's the credit, what's happening in credit today, what's happening in capacity today, and what's happening with collateral today. So yeah, it's dynamic out there and it's demanding at the same time, right? There's a lot going on. There are a lot of indicators that they're showing different directions. Sometimes they're in sometimes they're synchronized, sometimes they're not. Higher interest rates, which were projected to soften this year, right? We all thought interest rates were coming down, new administration coming in. They're remaining elevated on both new and used. We're seeing higher rates of delinquency in subprime, which are surpassing 2008 during the financial crisis. And speaking to those delinquencies, by the way, I mean, I sit and wonder because I think maybe it's priced correctly. Maybe this is the new norm that we're going to start living under. Because if I think in the other direction, then it becomes a really dangerous proposition of where you see just a flood of repossessions, right? Wholesale rates, things begin to work against the industry in a way that we haven't seen in a long time. And I think some of the themes that you'll hear at different conferences and you'll see in the news, affordability, right? That those are still constraints that are dampening car sales. March and April were strong, right? You had that pre-tariff kind of excitement that was going on, and it was heavily well marketed. But now in May, you saw some of the sales begin to tick down a little bit, and there was a little bit of a normalization. So if you think about it, May was lower, 3% lower compared to April. And then I'll just throw a few stats at you real quick to wrap up the answer to this question. Inflation is still a burden. We hear about it every day. You may have seen a well-known bank CEO forecast inflation to continue to tick up and unemployment growth. So those are two things we don't really want to see or hear. Wholesale used vehicle values through Manheim slipped 1.4% in May, but they remain elevated year over year. But we have to pay close attention to that for a number of reasons. Many current auto owners are car poor with PTI, mean payment to income, in excess of 30%, compounding kind of that stress on their capacity would be insurance rates are up 22.6% in the last 12 months. And we've seen through our data an 8% increase in homes where there's at least one uninsured vehicle. And then we move into record repossessions in 2024. And in 2025, year to date, we've seen an increase of 14.7% of submitted repos. Lastly, kind of moving into the last couple ones, the current administration in student loan reporting. They're going to begin reporting delinquencies. So the current administration came out and said, hey, folks need to pay these things. And one way you motivate folks to pay their student loans is you start reporting them to the credit reporting agencies, because negative student loan reporting could have an impact of 10 to 100 points on somebody's FICO score. And then, whoops, I'm sorry, something just popped up there. Finally, I read that 25%, and we're seeing data that 25% of cars today have negative equity in the neighborhood of $6,800, and that 8% of those, of that 25%, in excess of 15,000. So on top of that, still kind of going on here, we're seeing a demographic shift. So borrowers still, when they come into the market, they expect a digital, transparent lending experience. They're shopping around more than ever. They've embraced this journey. They come into dealerships, they come into the transaction being pre-informed, being pre-qualified. So when they step into the dealership, they're ready to sit down and have meaningful conversations with that dealer. And their expectation is you're picking up all of the information that I've supplied you. And there's a lot of it here, so that when we start this interaction, we're going to pick it up and move quickly to where we need to go, which is, let's see the vehicle. Let me understand some of the products that are being offered to me here, and let's dig into those details. And one really interesting thing that came out from a Cap One study I was reading the other day, Gen Z, the generation that has had the world in their hands since they were old enough to hold a smartphone, is actually doing more work in dealerships. Isn't that amazing? I think some of that is because, you know, they don't have as many human interactions, just because of the way that their life has been stylized and made is comprised of today. So I think that's something that they're looking to do with the dealership, because they haven't really grown up with it. Um, this is really forcing the lenders to be sharper, and not just in pricing, not in operations and risk oversight. The industry is required to be transparent, provide truthful and accurate information, touchless contracts, real-time income, insurance verifications. These were tools that sat separately within the organization. With AI, they're now being interweaved, and there's data and there's intelligence that's coming out of these transactions, so that dealerships who expect fast funding can receive it. But with that speed comes fraud. And I think it's projected to reach 9.2 billion. We all want to move quickly, but when you start moving too quickly, it allows some bad actors out there to commit and misrepresent either identities, documentation. It can happen at the dealership as well. Sometimes, you know, not only is the consumer potentially committing fraud, but perhaps there's some potential fraud that's going on at the dealership, either with the income or some of the documentation. All that to say, it's a growing vulnerability. So, you know, driving up the transaction and working with the buying public that expects real-time answers requires some real-time horsepower behind the solutions that are being built. Whew, gave you a lot there.
So many great numbers you mentioned, uh, especially that car insurance metric, and just the costs of insuring that collateral that you mentioned at the top. So many numbers to keep track of nowadays, John. Where do you think the blind spots still are for finance companies? So much data to digest nowadays. Where do you see the some potential blind spots coming into play?
You know, one of the clearest blind spots, in our opinion, is insurance verification, particularly around post-funding. So most lenders require verification of coverage at origination. That's supplied. You document that, and then the assumptions made from that point moving forward that the consumer or the customer or the borrower is maintaining it. But many borrowers, particularly in subprime, cancel coverage within days or weeks. So we currently monitor over 22 million automotive and mortgage loans, and we've seen a 25% increase in the rate of cancellation notices coming to Allied. So it could be these customers are continually in a cycle of shopping, or it could be that they can't afford it and they come in and out of insurance really just as their kind of their monthly budget enables them to, is to say, maybe I can jump into another monthly insurance program. Maybe I can jump out of it. So, but what really exacerbates that issue is a lot of our lenders are working with fragmented systems, right? They might use the investments, again, have all been made on the front end. They wanted to be digital. COVID forced them to provide new tools and enablements to consumers to really take this transaction, this car buying experience, as far as they could possibly take it. But servicing, refunds, tracking, and claims, it often it lives disconnected from what all of that great work that they've done on the front end to getting to the back end of the shop. So it's really that disjointed kind of data pass through and insights into their customers that the back end who so desperately needs that data to ensure the consumer is keeping their obligations, or if they're falling out of their obligations, how can we get that consumer back on track? That creates the delays in being able to take those actions quickly. So just as fast as you want to enable somebody to buy a car, you want them to be able to operate just as quickly on the other side when things become a little tough for them, right? So when they need to have really a relationship with you that helps keep them in their vehicle, helps them maintain the lifestyle that they have today, you want those tools to be quick, accurate, and transparent, just as you do on the front end of it. So, you know, we cannot forget that for indirect lenders, the borrower relationship is disintermediated or is intermediated by the dealer. So when something goes wrong, sometimes the customer is not sure who to go to. Do I go back to my dealer? Do I use them as the arbiter of working with my lender? Do I go to my lender? Do if I needed to provide insurance, I provided it to my dealer, but I let it lapse and I need to provide new insurance. Where do I send that? So again, it's not a clean space, it's a messy space, but there are a lot of really smart people out there working on this. There are a lot of really neat technologies that are being developed today. And I think that at some point in time, especially as what we're seeing with the capabilities of AI, that you're going to see this customer from the minute they express interest in buying a vehicle and become aware of your organization through all of the different signals that are going on throughout their loan once they've actually procured the vehicle and financing, all the way through to the disposition of the vehicle, and really understand fully, hey, this is my customer relationship. This is the direction I'm able to model behaviors. I'm able to have a better understanding of where within this journey is my customer headed and where can I be of additional value to this customer when they hit certain intersections in that journey.
Again, the voice you're hearing for this special sponsored episode of the Auto Remarketing Podcast is John Elias with Allied Solutions, and focusing our conversation, kind of a pulse check on auto finance, and examining some of those blind spots and risk areas that are in play. And John, I thought you just articulated so well that disjointed environment from the front end to the back end of in within a single company a lot of times. Do you feel that's where the seeds of risk are most germinating, or where are some other places as well that you're seeing that risk is starting to percolate here and could become a major issue down the road if not addressed?
Yeah, yeah. So, as we discussed, the innovation up to this point has really been sitting on the front end of the transaction. Again, super smart about credit decisions, e-signatures, approvals, AI-based introduction. But again, those risks are still sitting in servicing and in risk kind of oversight as a whole. Unfortunately, lenders today are really dealing with legacy systems, as I mentioned before, and models that are too rigid or expensive to scale. So one of the ways, Allied has recognized this risk is, if you think about it and the things that we do and the services we provide, we kind of stay ahead of these issues as they're developing, and we start to to plan for these issues, and we try to work closely with our partners to plan for these things. So we're not running away from these issues as they're developing, we're running towards them, and we have been for years. We really made some slick technology investments, cultivated some wonderful strategic relationships, and refined our processes. But if I just wanted to say, if there's a risk out there that I think is really embedded in there, and maybe a little bit of a surprise to folks, which is really hard to manage from the rear view mirror, is the insurance arena. So a lot of our lenders, and during conversations, they're avoiding tracking that insurance, thinking that that's really just a component of, for example, a CPI program. But some of the other lenders that we're working with are beginning to ask those really good questions of, how do we build modular, scalable verification models that adapt to the borrower segments? And what we mean by that is certain segments have different risks associated to them. My super prime segment of my portfolio is going to behave quite a bit differently than my subprime sector. So how do I help build solutions and strategies across all of these different segments of my portfolio when I'm really dealing with some antiquated technologies? I'm dealing with, a cost issue that's involved here, right? I mean, do I make investments to increase my technology? Do I hire more FTEs? What they're trying to do is figure out, how can I solve for all of these risks while keeping my cost in line with my returns that I would get from adjusting to these risks, and being proactive about them. It's almost like, I think I heard a car dealer say they're trying to cut the table cover to the size of the table, right? So just to ensure that you've got just the right amount of coverage, and you're not overpaying for coverages that you see as may not be offering the right level of return. So they're using verification data not just reactively these days, right? But we're also using this and helping them point to predictive behavior and the data for those segments of the portfolio where some additional risk may be hidden, how that data can help them predict better behavioral outcomes and to begin to plan for them in advance. Because at the end of the day, insurance has a high correlation to claims recovery. So if you're thinking that you're already operating in a volatile market, you need to optimize when these events happen, your recoveries. The way to help do that is to identify these risks of consumers that may or may not have insurance, help address that with the consumer, get them back on track, and then also to monitor the behaviors as to, this is indicative, this is directionally pointing me to, maybe I need to have additional conversations with my customer, because at this point, if insurance is an issue, there's probably larger issues at play.
Closing moments here on this special sponsored episode of the Auto Remarketing Podcast with John Elias, who is with Allied Solutions, and focusing our conversation on a pulse check of auto financing, and being aware and cognizant of those blind spots and risk that certainly are in play. And John, just to round out our conversation, you referenced the dialogue that finance companies might be having with their customers, especially for listeners who might be part of the leadership team at a finance company, whether it's face to face across a conference room table, or via Zoom, or however they're connecting nowadays. Just what questions perhaps should they be asking internally to address the matters you've so nicely laid out and articulated? How can they go forward from here, do you think, John?
I think one lens that you really can't stop looking out of would be compliance. It's still a huge factor. And as unfortunately we see repossessions growing, delinquencies growing, total losses. Again, if you knew in advance that your customer did not have insurance, you're going to take different actions sooner, as opposed to waiting for contacting an insurance company who only comes back and says, no, there was no coverage here. But all of those are being very closely watched. Heavy consumer impact, customer impact. What's happening during these events? will be continuously modernized, or I would say modernized compliance, meaning they're becoming smarter. They're looking at the systems. They're looking for the gaps in the systems. Use this time to modernize your infrastructure, because if you're operating across multiple states, you're in indirect lending, you're at storefronts, you have fintech models, you have tech stacks layered all over the place within this transaction. Ensure that those tools are built for the way that you want to operate, to ensure that you're compliant, so you can build your governance and you can monitor what should be happening on a real-time basis. So, you know, it's important to scale safely, and what they're really asking for today. And this is the questions that come into us, Nick, was we need tools that are configurable and adaptive. Not one size is going to fit our organization. So help us figure out, determine where your tools can fit into the workflows that we need. Because if we are looking to upgrade, or we're looking to up level, maybe help outsource some of these processes today, we have to ensure that they're running compliantly, that we can do it on our terms, when we want to use them, how we want to use them, when we want to continue our own work in-house, and to ensure that there's no slippage as this is going back and forth that would open up a potential issue where a consumer may be impacted, a customer may have a bad experience. We don't want that, because those bad experiences, and I can tell you right now, Nick, I was on the CFPB webpage the other day. There are things that the complaint portal is still open. And if you read that, there are things here that, a lot of it's pointed to repossession activity, the amounts of the lenders are pursuing for, hey, this is your deficiency balance. They're creating questions around how accurate is that, and also practices. So again, the practices of where technology and humans are interacting, not only optimally, but with compliance, and also with the opportunity to continue to build a better customer, even during the hard times, a better customer interaction.
And John, speaking of connecting, how best can listeners get connected with you and the great team at Allied Solutions?
Yeah, you know what? Thank you for that. You can reach me at john.elias, Elias, at alliedsolutions.net. My phone number is 419-494-4765. Open to taking any calls if there's interest in the material that we discussed here today. If you just have an odd question, where the question may be, hey, can my customers still file a gap claim even though they didn't have primary insurance? There's a lot to that answer. So please give us a ring. Those are things that we see day in and day out that our lending community is struggling with. And we're happy to be here at any time for folks that are listening to this, and for our clients today, and for our clients tomorrow.
That's John Elias, one of the many experts at Allied Solutions. John, thank you for taking us through the current auto financing landscape and offering some great suggestions of what to do next. Always great to speak with you, sir.
Same here. Thank you, Nick. Have a great rest of the week, and hope to see you again shortly.
Absolutely. And if you've missed any of our past conversations with experts like John Elias from Allied Solutions, you can just go to our website at autoremarketing.com and click on the podcast box to find our library of past episodes, or simply subscribe through whichever platform you get your podcasts. For fellow hosts, Bill Zadites, Joe Overby, and Andrew Friedlander, as well as our outstanding executive producer, Matt Rice. I'm Nick Zulovich. We thank you for joining us, and we look forward to having you again next time on the Auto Remarketing Podcast.